Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital, and joining me today would typically be Michael Becker, but since it's the day after Thanksgiving, I'm hoping that he's enjoying a turkey sandwich with his family. In this podcast, we're going to feature the Old Capital Multifamily Conference Lenders Panel. That's the one we talked about last week or so that we will be replaying. And that's where we talked to Fannie Mae and Freddie Mac and some of the bank lenders about what's going on in apartment financing. So we want you to listen to what the loan decision makers are looking for when they approve your apartment loan. So we had an in-depth discussion in front of about 475 investors at the Old Capital Conference last month in Dallas. And hopefully you'll take away a few nuggets of underwriting information that will help you succeed in financing your apartment transaction. So without any further ado, let's let you listen to the Lenders Panel. Have a great day. Thank you. All right, let's get everybody up here. Let's get the group of the guys that look like they are undertakers, better known as lenders. So this is the Lenders Panel, and I'm going to be Phil Donahue, and I'm going to be walking around. And I'm going to get your questions answered because you have questions that you've got to know the answers. So first of all, I want to kind of introduce some of the guys in the panel here. So we're going to start on the far side. So this gentleman right here, would you introduce yourself?
So my name is John Darrow. I work with Sabal Capital Partners. We are Freddie small balance lenders, seller servicers, nationwide, non-recourse. Really the bread and butter, the sweet spot for us is $1 to $7.5 million, stabilized, cash flowing, mixed use and multifamily properties. Minimum units is 5 units, and then we can go up from there. But really looking for just good, stable properties throughout the United States. I'm based in New York. I've been working with Paul for two and a half years or so.
Pretty much since the program was announced.
Correct. I'd say half this room we've worked with on some deals, and then the other half, we're ready to work with you as well. So excited to be here, and Paul's a great client of ours.
Thank you. Who's the seller guy next to you? And you can stand up, Fritz.
Am I that lucky?
Yeah, you can stand up.
Hey guys, my name's Fritz Waldvogel. I'm with Doherty Mortgage. We're a Fannie Mae lender, an FHA lender located in, as I mentioned, Minneapolis, Minnesota. I'm based in Minneapolis, but I'm down in Texas here about every other week. Now that Paul's daughter's off to school, I've kind of joked that maybe you got an open bedroom that I can stay in every other week when I'm down here. But
do you know what this guy did before he got into the lending? Any idea?
Close.
He was football. He played professional football. Where did you play professional football at?
In Germany.
So he played professional German football. American rules.
Yeah, thank you. A few concussions, but not too bad.
All right, so Fritz is with Doherty Mortgage, Fannie Mae. We're going to talk with him a little bit more. Tony, I'm going to have you stand up too. This is Tony Spaeth.
It's good to be here. I'm with Greystone. I opened our office here about 15 years ago. When you hear Greystone, just think multifamily. That's all we do. We did about $7.5 billion in multifamily finance last year. When I started 15 years ago, it was about $1 billion, $1.5 billion. So we've just constantly grown with this great market that we've been a part of. We're self-proclaimed king of small balance lending. We used to do that with Fannie, and Freddie came to us and said, we want to get into it. What do we need to do? So we helped him get into it. And we do a ton of that, but we do large loans too. We're Fannie, Freddie. We're the top HUD lender, FHA HUD lender in the country for the last 5 years. And we also have a bridge loan program. So if your property you're buying doesn't qualify for agency financing, we can help you acquire it, fix it up, and then help it move into a permanent fixed rate loan with one of the agencies. We're a little unique in that we do most of our business through correspondence, like Old Capital Lending, and that's my background, and that's where I get all my business. So we appreciate them very much and appreciate you, and it's good to be here. Thank you.
Thank you, Tony. Robert.
I'll sit for this.
He's tall.
My name's Robert Canaday. I work for Independent Bank. Independent Bank is an $8 billion regional bank actually headquartered in McKinney, Texas. We specialize in all types of lending, from commercial loans to small business loans, mid-sized business loans, also consumer loans as well. We offer a wide variety of depository type accounts, treasury management services, and investment advising. I've been with the bank here since 2011. Been in a number of different roles here at the bank, from underwriting to commercial lending. I'm actually a commercial lender now, so that's where I hopefully will be for the next few years. But I have seen the growth of this bank over the past few years, which has just been outstanding. I mean, when I started in 2011, we were about $1.2 billion in total assets, and we've grown to over $8 billion where we currently are today. We have over 60 locations in Texas now, 8 in Colorado, so that's just terrific growth that we've had, and it's been amazing to be a part of. Like I said, I'm a commercial lender. I specialize in all types of commercial real estate. I do have a concentration in multifamily lending, which is why I'm here today, but we do lend on almost any asset class that you can think of. Old Capital and I have worked together on a number of different deals, totaling somewhere around $28 million, but we've just had a great time working together.
Fantastic. So you guys bring in the 20%. These best friends of yours bring in the 75 to 80%. So get to know them very well. Buy them a drink tonight, please. Spend some time with them. So this is going to be a very off-the-cuff conversation. So I want to have you guys think about some questions. I'm going to ask some questions, but I want to get the questions that you have answered. So I'm going to kind of kick it off. So this first question is to Fritz. So Fritz, and I wrote this down too so I wouldn't forget it. So we hear terms like KP, guarantor, sponsor thrown around quite a bit. For Fannie Mae debt, can you clarify exactly what experience is needed? Is it just signing on a prior multifamily loan okay? Or is it for prior deals, does the borrower need to legally be part of the management entity and have actively managed the asset? Or can you just be a limited partner on a few successful deals? What does it take to get a Fannie Mae loan? That's a big question.
Yeah, it's a big question. Fannie typically requires at least some multifamily experience. In a rare instance, we have done deals with Old Capital where someone doesn't have any typical multifamily experience, and that's mitigated by maybe not as aggressive terms, and you have a full-on, third property management company in place. But typically, whether you're a KP, we prefer, if you've signed on a Fannie Mae loan in the past, they like to look in the previous deals that you've worked on in their portfolio that are performing. That's an important piece.
And what's a KP? I don't know that term.
A key principal, so someone that has some sort of managerial role in the LLC or borrowing entity. But even if you do sign as a limited partner, we will consider that as some experience. But like I said, we do prefer guarantors or key principals.
Okay. John. So John Darrow from Sabal, handling the small balance Freddie Mac loans. So many buyers are starting to branch out to the tertiary markets due to competition in the major metros. What do we need to know about the Freddie Mac small balance lending in these smaller markets? The LTVs, the IO, the experience?
Well, first of all, I guess the best way to put it is we will lend nationwide. So we do lend in the tertiary markets. Kind of going along that lines, most investors are reaching out there because they're going for yield, which we understand, but with yield, the higher cap rates, there's a little bit more risk involved. So Freddie Mac, especially in very tertiary markets, is going to want to take a look at the deal before I send you an application. So some of the things that you should keep in mind on an acquisition will only be about 75% loan to value. On a refinance, we're only going to give you 70%. We're going to cut back the IO to, you're not going to get more than 2 years of IO in these markets. Your coverage ratios are going to be a little bit higher at the 130, 140 range. And then finally, you want a sponsor that has experience. So a great story would be, I live in Dallas, but I'm investing in Wichita Falls. and I got 500 units, and this will be the 6th property in my portfolio. That's a great story. The story I don't like is I live in California, I have no experience, I work in tech, and I want to buy in Wichita Falls. That's a harder story to sell to Freddie. So it's a little bit more subjective. Freddie is a great partner of ours because they've painted a very clear box about what we can and can't do. But once you start to get into the more tertiary markets, it becomes a little bit more about the narrative and the experience. What
is a tertiary market? How would you define that?
I don't know the actual population offhand, but usually what I tell people, it's less than 30,000.
And so if the transaction was here in Dallas and Fort Worth and maybe some of the surrounding area, what would the maximum LTVs and IO and leverage and all those things? What's that going to be for Freddie Mac?
In Dallas, you're a straight 80-80 market, so you can get 80% on both a refinance and an acquisition. You can do partial IO up to 3 years. You can do full-term IO for 10 years. So Dallas is a strong market.
So listen, full 10 years IO?
You can do full-term IO. I know it's a sticking point. But
wow. What LTV is that?
In Dallas, to do full-term IO, you're going to want a 140 coverage and a 65 LTV.
Oh, 65. You didn't say that. Okay, 65. All right. Okay.
There's always a catch.
All right. Next question is for Tony. And you can tell Tony's a little bit of a old lone dog like I am, little gray hair. So you've seen an apartment downturn or two. What do you see triggers a pullback? That's question number one. Why is this market different from the last one, and do you see any similarities? And what do you think about all this interest only? Is that an indication of the beginning of the end?
First of all, I'm experienced. I'm not old. Just let's put that straight.
All right.
Fair enough.
Thank you.
Although I did just find out my daughter's going to have a baby, and I'm going to be a granddad in March, so that's pretty cool.
Congratulations.
Thank you. So I've been through a few cycles, and it seemed like it's always, seems like it's always about 10 years, 5 up and 5 down. And I've been doing this since the early 80s, and it also seems like we skipped a cycle. Am I too far? And it's been wonderful in the apartment industry for 10 plus years, and it still looks pretty good to me. So what typically causes a down is one of two things or both. And we do this in Texas better than anywhere else. We overbuild. Every market gets overbuilt. And then job loss, you can follow a market, and if there's job gains, it's probably going to be a good market to invest in. If there's job losses, probably not a good market to invest in. So that's been the traditional indicator. But what makes me optimistic is two things. We have the young folks, the millennials, the Generation X, Y, whatever you want to call them, they're preferring to stay in multifamily, to walk to the bars and the restaurants, to get on the hike and bike trail, close to their job, and they're foregoing for a while marriage, buying the first house, the kids, all that kind of thing. So we have a much bigger, younger market. And then the ironic thing, we also have a much bigger, older market. Baby boomers like myself. I mean, I've done this. I sold my house in Colleyville. I'm living in downtown Grapevine at 925 Main Street, wonderful place, but I downsized, and my kids are out of the house now. So you have baby boomers feeding it from there, and you have the young generation. So we got a perfect storm going on right now, and multifamily's the beneficiary of it, no doubt. So that does make me very optimistic. Paul mentioned IO, and IO can be a good thing, and it can also be a very dangerous thing. I think back 10 years ago, there were some lenders that are not represented up here that are a 4-letter word to us as competitors. It starts with C. And they were doing full leverage 10-year IO loans, which as a borrower, you're like ecstatic about that. But what happens when 10 years is over and you've got to refinance? You could be underwater. So IO is something that I think all of us, we just do it based on the leverage, like you heard. If you want max leverage, you're going to get minimum IO. If you want minimum leverage, you'll get maximum IO. So that's the way we deal with it to make sure you're really not an issue.
I actually think that IO is dangerous, especially at the higher leverage. Fritz, tell me a little bit about how you get max IO. I mean, you guys are delegated with Fannie. How many years IO are you delegated, and what's really delegated mean? And then when do you have to go to Fannie, and what are you looking for to get the longer term IO?
Sure. So at full leverage, 80%, we're delegated to 1 year of interest only when you're at 10 years or longer of a loan term. If you get down to 65%, we can go up to 5 years of interest only. And then if you get to 55% LTV, we'll go up to 10 years of interest only. And that's what we're delegated to do as a Fannie Mae lender. Now, if you want to go above and beyond that you have to go get Fannie's approval. And there's a lot of variables that go into how much IO you get above and beyond what's delegated. I think a lot of people compare deals and say, well, they got 2 years, they got 4 years, and some people got 5 years of IO. And it's like, well, why didn't I get 5 years of IO on my deal? And each deal is so different. There's a lot of metrics that go into that decision. If Fannie will look at it and say, okay, at the end, say it's a 12-year deal. We'll look at it over a 12-year period, and at the end of that period, can we pay off our loan at an 80% leverage and a 125 debt service coverage? So there's a bunch of metrics. We'll raise rents by 2%, expenses by 3%, have a refinance rate of 725, and a 200 basis points or 2% increase in your cap rate. And at the end of that, can we get out of the deal? I mean, these aren't not bank loans. I mean, these are mortgage-backed securities that at the end of the period have to be paid off. And at the end of the day, it's up to Fannie's discretion.
Yeah, if you went back about 6 or 7 years ago, we really didn't have interest only. And then it became 1 year of interest only, and then it became 2 years of interest only, 3, 4. Now it's 5 years interest only at max leverage at 80%. And just like what Fritz is saying is that they have to stress out the deal. Because if you get 5 years of interest only on a 12-year term, you're not paying anything toward your principal for the first 5 years. And so what happens, what are you counting on? Appreciation of rents, decline of cap rate. I mean, there's a lot of things that you're out there keeping your fingers crossed and hoping that the winds continue to blow in your favor. But then as a deal sponsor, you're up against a lot of competition. The competition for the transaction and competition for the dollars of equity coming into the deal. And to get the dollars of equity coming in the deal, you got to juice the returns. So the IO gives you a little bit of a juice on the returns. So we're a little concerned about that, is that if we can't keep the cap rates compressed, keep them going down, or appreciation of rents, what's going to happen on a downturn? We could have a problem. So I think we overly inflate these units a little bit by having too much IO. I wish that Fannie Mae, again, personal opinion, wish Fannie Mae would kind of dial back the IO. I know it's good for us as investors, but I'm a long-term player. I've done this for a long period of time. I want to be around more than 18, 24 months. Okay. I'm off my soapbox. All right. Robert, you are a bank bridge lender based in the DFW area. Many of these folks have never purchased an apartment building. Why would a buyer need a bridge loan, and what do they need to get an approval? Question number one. And what are some of the items a potential buyer needs to know?
So I think that there's a number of factors to this question. What can we really offer as a bridge lender? And I think one of the points mentioned earlier was experience. If somebody hasn't bought an apartment complex or owned an apartment complex before, we can certainly step in there and make a loan that can make sense for everybody. Like I said, especially if there is a certain lack of experience.
So you could put them into business.
We could put them in the business, and we often have. We've grown very significantly with a lot of our customers.
Where Fannie and Freddie typically will not put you into business.
Correct.
Okay.
There's also a lot of other standards that Fannie and Freddie require. One that comes to mind is occupancy. So a lot of the times, I think Fannie and Freddie require a 90% occupancy, if that's a correct metric. We don't as heavily look at occupancy as other lenders do. We're more of a cash flow lender. So, if we can get that debt service coverage ratio to a cash flowing level, and I'm not talking, at a level where you can pay back your investors, at a healthy level, but where our debt's being paid, all the expenses are being paid, property is performing, we can make a loan on that type property. Another thing, kind of still on the subject, is our process tends to be pretty quick. We have everything we need from day one. I can get a commercial real estate deal done within a 4 to 6 week period, and that's from the second we meet and start considering the property to the closing table. So a lot of our borrowers really appreciate our speed. We offer rehab type loans. We do offer interest only periods, not quite to the 5-year mark. I think that's kind of scary, but we offer interest only periods up to 18 months with a rehab draw period as well.
So why don't you guys do 24, 36, 48 months of interest only?
Why wouldn't we?
Why don't you?
It's just horrifying.
Because the regulators will not allow that to happen. It goes in the books as a non-performing asset.
Correct.
So they're just a temporary loan. To be something deficient about this property to do a bridge loan, whether it's the management that has a problem, the rents are not there, the rehab dollars need to be put into the deal. There's a problem with this property. But that's a recourse loan. They're a recourse lender. So if there's a problem with the property, they're going to take an interest, not only in the collateral, the business, or the building itself, but also in your personal balance sheet too. So just know that. But they also have some flexibility. What they can do, they can put you into business also. So just know that in your head. That can happen. Anything more to add to that, Robert?
I think you had another point to your question was what type of things do we look at for a specific buyer. We do look at the property. We underwrite the property very heavily, but we do underwrite our guarantors since we are making a recourse type loan. We look at a personal balance sheet or personal financial statement is what we call it. We look at your personal liquidity, and we look at your AGI on your tax return, any other investments that you've been in, whether as a passive investor or a managing member. So we look at your resume, and we really do dig into the guarantors a lot more heavily than other lenders look at. So, just for some documentation we'd look at tax returns, that personal financial statement, we'd ask for bank statements, a resume of some sort. And then for the property, we dig into the property financials as well. I think that about answers your question.
That answers my question. Good. Okay. Be thinking of questions out there because I'm going to call upon you if you have questions. This is a 2-part question for Tony. So Tony, in what instance would a borrower use a large balance Freddie Mac loan instead of a Fannie Mae loan? And then 2, can you introduce the small balance program that competes with the Freddie Mac small balance loan?
So, as you know, Fannie and Freddie compete with each other just back and forth. But generally, Freddie prefers higher quality real estate, so B quality and certainly A, where Fannie will certainly play in the C quality and B and A as well. But because of the higher quality, what I found is Freddie will beat Fannie. The dollars are going to be relatively similar, but interest rate, Freddie's going to be tighter. On average, maybe 20 basis points tighter, depending on the deal and how you request waivers and stuff. But generally, Freddie's got tighter pricing and Freddie will offer even more IO than Fannie will. So I know you were complaining about Fannie, but Freddie's even more. They're more aggressive in that there. So,
but unfortunately, you guys cannot underwrite the deal. It has to go right to Freddie Mac first, right?
That's right. Freddie also prefers the stronger markets. So tertiary, they'll look at it, but they prefer the stronger ones where Fannie will look at, all markets and that type of thing. So there is differences, but generally that's why I would recommend Freddie is if you're in a strong market with a B- quality property or better, Freddie's going to be from a rate and an IO and all that type of thing, potentially a slightly better execution.
Tell us about that new small balance Fannie program.
Happy to, and I have some personal experience with it. I was honored to be selected to sit on Fannie's Originator Advisory Subcommittee, and I started last year, and one of the things we asked for was we said, guys, we got to have something to compete with Freddie's SBL product, their hybrid product. Fannie didn't have one. And they listened to us, and I don't know what it was, a month ago, 2 months ago, Fannie announced their hybrid product. And it is very, very competitive with Freddie's hybrid product. It's 30 years fully amortizing versus Freddie's is 20 years fully amortizing. And what it is you get to pick the initial term of 5, 7, or 10 years of fixed rate financing, and then it converts to floating rate financing. And the cool thing is during that fixed rate term, 5, 7, 10, it's a step down prepay. And then once you're through the fixed rate and you're in the floating, it's open prepay. So it's an extremely flexible product. So if you don't know what you're going to do with the asset, I don't know if I'm holding it 5 years, 10 years, maybe 2 years. Somebody makes me an offer I can't refuse. It's a great product. It's assumable.
Can you put some rehab into that deal too?
I don't think so. Was that a question that you knew the answer to?
Yeah, you can.
Okay.
So yeah, that program was just introduced in probably about a month ago or so. So I'm letting other people explore it before we really go into it, because I don't want to have any of your transactions be sacrificed if something goes wrong in those deals. I'm going to let everybody else that we don't do business with get sacrificed until they get the kinks out of that deal.
Paul, a couple other things the Fannie product does that Freddie doesn't is they'll allow green financing, and we haven't spoken about green yet, but you need to know green financing. It's very easy to qualify for. You get a lower interest rate, so you need to talk to us about green. You can do mobile home or manufactured housing communities in the Fannie hybrid program, and some other products that aren't allowed with Freddie that you can with Fannie. So it's a very good product and very competitive, and they just rolled it out.
Let's get back to Fritz concerning the green program. Can you explain that, what the Fannie Mae Green Program is and the benefits? And then what happens when the Green Program was already implemented by the seller?
Yeah, the Green Program, it would be interesting to see Fannie's numbers at the end of the year, but I would bet close to 40 or 50% of all the market rate deals are probably green.
Can I just jump in? I was at Fannie's headquarters Tuesday, and Fannie has done $40 billion year to date. $15 billion of it has been green. So there you go.
Yeah, it's pretty incredible, and that's important for a lot of reasons. The green deals do not count towards their cap, so Fannie and Freddie each have a $36.5 billion cap, and if you do green loans, it doesn't count towards that number. But back to the actual program, I mean, the big benefit of it from an underwriting perspective, and for you as the borrower, is you get a large interest rate deduction depending how large the deal is. It can be anywhere from 25 to 39 basis points off. And to qualify for the program, we have to order an extra report when we start the process. And when they started this green program about a year ago, the problem on a lot of these acquisitions was that green report would take 4 or 5 weeks, and when you have maybe a 45-day close, 60-day close, it can be a little tricky to get that report in. But they've done a nice job this year speeding up that report to be able to get that done in about 3 weeks. It's about $5,000 to $9,000 extra deposit up front, and assuming you move forward with the green program, Fannie will reimburse you for the cost of the program. And to qualify for the program, basically this report will spit out a bunch of different options, whether it's water savings or electrical savings, and you have to either have 20% savings in either water or electrical. And really the only one that makes sense most of the time is the water, and cost for that would be maybe $100 a unit. I mean, if you get $100 a unit in total cost, and you get, say, 33 basis points off, it's really worth it. The quick ones that are easy to do are really changing the aerators in the bathrooms and the kitchens, and then as well as replacing the shower heads. We've seen that qualify you just by doing those few things. And I know on a lot of these acquisitions that we do with a lot of the people out in this room, I mean, you're planning to do those things anyway. So it's not like it's an extra cost you weren't planning to do.
Good answer. So John, here's a question for you, since we haven't picked on you. So an LOI has been accepted, the term sheet's been signed, hard money has been pushed over to the seller, and third parties are ordered and paid for. And now the seller has taken their foot off the gas, collections are down, tenants have moved out. What are the rules with declining income and occupancy?
I've run into these a few times. I guess the easiest way to put it is the way that the agency or Freddie looks at deals is on a T3 income basis. And you take that and times it by 4, and that's how you're generating your net rentable income. There's a story that can be sold if there's a good reason why that happened, but usually If the income's going the other direction, especially if you're trying to buy the property, it's something that you should probably talk to the seller about, what's going on here. What we have done on other deals is you just need to get an extension and extend out the contract and try and let it bake for a little bit longer. I've had deals in the past where it's declining income, and Freddie's come back and they said, all right, you know what, I'll still do this deal, but I'm going to charge you an extra 5, 10, 15 basis points because, there's more risk involved than when we originally signed this up. So again, there's a few different ways of getting around it, but it's generally not ideal. As a buyer, especially on an acquisition, I would be somewhat alarmed in the sense that I would probably want to know, did he really take his foot off the gas, or is there something else that's going on at this point? Really, the market's not sustainable there.
James, any questions coming up?
Who's going to step up?
Pass.
Paul?
We have a bridge loan product that is non-recourse. It's not sub 1.0. We want break-even debt coverage or better.
All right, that's a tough one. So tough questions. I go to the expert over here, Jonathan Farrell, who does a lot of our bridge loans, who just came over from Legacy Texas Bank over to Old Capital. Jonathan, what's the answer? Non-recourse bridge lending, secondary, tertiary markets.
Would echo what Tony said. I mean, those products are available, but typically you want a 1.0 coverage or better. If it's sub 1.0 coverage, you're generally looking at a private bridge or a debt fund. They'll basically put up an interest reserve to cover the shortfall for, again, they're going to underwrite to what the pro forma is. So if you show 6 months worth of negative cash flow, they're going to want an interest reserve for that up front. So, but they're more costly. So you're not going to compete with these guys on rate. They're going to be higher origination fees and higher interest rate.
You're full of good news. So the answer is it can be done. Talk with Jonathan, he can do it. But just like he said, if you're trying to do bridge loan, recourse, he's in the 5% range. Non-recourse can be anywhere, if it's tertiary market, 5.5%, 6%, and sometimes even higher non-recourse bridge lending. James, any other questions?
Yeah, we got Dylan Marma. What's the best practices, or what have you seen out-of-state investors do to improve their chances of loan approval?
Experience is one. Buy in a top or primary market is another one. Good third-party management company, local third-party management is another one. Maybe bring in a LP that's based in that market that has experience. That's another good one. There's a handful of ways that you can get around that, but yeah, definitely I'd say one of those 4 elements, third party, local.
Yeah, if you're going to do your first transaction, I would typically say you want to do it in a major metropolitan area, because if you don't have multifamily experience, again, just like John said, bring in an LP that maybe has multifamily experience, bring in a multifamily property management company, and that would sometimes get you going. Robert, any other questions or any answers on that one?
Yeah, I'll add to that. Obviously, good property management, if the buyer has experience, always helps. But I think the main thing that we would look at for an out-of-state investor would be the equity injection. Typically, if we're going to offer a 75 to 80% deal, maybe we would require an extra 5 to 10% to really mitigate that risk for us at least.
I would also say not all lenders are like Independent Bank. There are a lot of lenders on the bridge side that do not like Californians, don't like Floridians, don't like new people from New York. It goes back to about 20 years ago or even 15 years ago when properties were defaulted on by all these out-of-state investors, that everything they touched turned to gold. They came there with their money to Texas and they got some of these bank loans. Well, as soon as the times came hard, they hightailed it back to California and they couldn't go after those people. So a lot of the lenders still remember those deals. So don't feel bad if you don't use us or don't use Robert as an example. Other lenders still remember the Californians and the out-of-state people trying to do transactions. So, James?
Juan Vargas had a question around interest rates. And then, so maybe crystal ball on interest rates as it ticked up the past couple of months. And then also, maybe within your program, when do you actually lock the rate?
John?
So Freddie Small Balance gives you a free rate lock. As soon as you sign the application, they're going to hold your spread and your index for 35 business days. And all we have to do in those 35 days is just submit for approval with Freddie Mac. We don't even have to close the loan. So your spread and your index will be held for basically 7 calendar weeks. Just get us the information. We don't have an issue hitting that. Some of our competitors are a little bit longer, so they may have an issue getting their packages in 7 weeks.
They're a little faster. Okay, so you can rate lock up front. Fritz, can you rate lock up front, or when do you typically rate lock?
We typically do not rate lock until after loan commitment. So that's usually 45 days after signing the application. We have all the third-party reports. We've done all the due diligence. And we collect a 2% deposit of the loan amount before you can lock, so we hold that until after securitization. But Fannie did come out with a new program, I would say, within the last 12 months. It's called the Streamlined Rate Lock, where you can lock basically whenever the lender has enough due diligence that they believe. Usually, I would say, third-party reports, but I would warn people from doing that because depending on how long you rate lock, it's either 2 or 3%. And you take a lot of risk. When we sell these mortgage-backed securities, you have about a 5% variance. With whatever you sell, it can change once it delivers the investor by 5%. And what happens if, a scenario like John was talking about, say you lock 2 or 3 weeks in, you get the next month's financials, and they tank. And so now you no longer can get to loan proceeds. You put up 2% of the loan amount, and if you don't deliver at that loan amount, you lose your deposit. So there is risk there. Now, we had dinner with some Fannie folks last night. We were talking about this specific program, and where they see it as, the reason they really created it was, say it's a refinance of a deal that they own. It's a stabilized asset. The borrower, they already own it. There's not a ton of risk there, but I would say on an acquisition, there definitely is, because you're not operating the property. You're trusting the seller to operate the property correctly.
Tony?
First of all of our crystal balls are broken. They don't work. And if anybody says they have one, it doesn't work. But shoot, I've been predicting rising rates for at least 3 years now, and we're still, in the 4s. And I've been doing this a long time, and I would tell you the average interest rate on a commercial property has been closer to 7%. So guys, enjoy this while it lasts. It won't last forever. It's phenomenal, and the yields you can get because of it are incredible. But they got to go up, right?
Well, we just had Dr. Dotzer down in San Marcos last Thursday, and he was saying that they're not going to go up. So good for him. All right.
Is he an economist?
He is.
There you go.
So that means that he's only half right. So, Robert, when do you guys lock your interest rates?
We don't actually have a formal rate lock system. The majority of our rates are based off of Wall Street Journal Prime. And what we typically do is just quote a rate via a term sheet based on what we think the rates are going to be doing within the next, few weeks. These term sheets aren't good forever. They do expire. But our quote unquote rate lock is at approval. So as soon as you're approved, our approvals are good for 90 days. I can't really think of any situation where we would hold on to an approval longer than 90 days unless something just catastrophic goes on. But when you get approval, your rate's locked. We're not going to change that.
That makes sense. Gentleman in the back, Kelly, did you have a question, sir? Rates.
I'm doing right now 2 of them, one in Denison and, up north on the border with Oklahoma. So definitely a secondary or tertiary market. The rates today are going to be in the high 3s. That's right, the high 3s. You have to add mortgage insurance on top of that. Mortgage insurance is another 60 basis points. So let's say all in you're 4.5. But I'm going to go back to that green word again. If you qualify as green, I'll knock 40 basis points off your mortgage insurance. So you're going to be around 410 all in. And guys, that's a 40-year loan fully amortizing. It's pretty darn good.
Yeah, that's good. That's good. But now tell us the reasons why you do not want to do that program unless you're a developer. Well, how long is it taking you to get these loans through the system for one?
We're doing them in about 9 months. It used to be 12. We've got a streamlined 9 months.
So that's a streamlined nine months.
Yeah.
It's a pretty competitive market these days. Do you think the seller's going to wait for you 9 months? I don't think so. Give me 2 other reasons why you should not do an FHA loan.
So it's the time and it's the cost of the loan. It's very expensive to close a HUD loan. You're going to pay points, like triple the points you would for a Fannie loan. So it's not for the weak at heart, but the rates and the proceeds are 85%, not too bad.
Yeah, that's not too bad, but I will preface, we do a lot of HUD business. We're a top 10 HUD lender in the country. We do a lot of it. It's great. But it's for certain borrowers, I would say. I mean, it's a lot of headache to get there. You know, what we say on the construction side with the D4 is basically when you have 90% of your plans and specs done, add 90 days. So it could take, if that takes you 6 months, great, we can close in 9 months. But if that takes you a year, you're over 12 months. A lot of investors here that you're used to a Fannie or a Freddie or a bank loan where you can take cash out whenever you want and distribute it to your investors. You know, on a HUD loan, you can only take out cash twice a year, and you have to have audited financial statements. You have to add that extra cost on as well.
Yeah, cash out means paying your investors, not cash out, but cash out like you would get a distribution on a monthly or quarterly basis, twice a year, plus you need audited financials, which could be another $10,000 to $15,000 more a year. And it really doesn't work. What we do in the B and C market, it just doesn't work. So you can do it, but I don't recommend it. You'll be pulling your hair out. Any other questions, James?
So Gregory Cantrell asks, with rising interest rates, how are you underwriting your reversion or exit cap versus going in purchase caps?
And what is a reversion cap? I've heard that, but I really don't know what the heck that means. James, I'm going to have you. What does that mean?
Reversion cap, you know, most people are running like a 5-year discounted cash flow on their models. So what cap rate are you going to sell the property at in year 5? And so if you're going in today at maybe a 6% cap on a B property, what are you going to use as your reversion?
Yeah, so I mentioned it last when I was talking earlier in terms of what we look at when we exit the deal. You know, what we do, we add 200 basis points to whatever it was underwritten at, and that's what we use for our exit analysis on our end. So 200 basis points.
I'd like to say it depends because different markets are underwritten different ways on the small balance program. So some markets aren't stressed, other markets are, but it's going to be anywhere from, you know, again, 0 to 150, depending on the length of the term on the loan. One of the bigger things that we also look at is the loan to value at maturity too, which kind of speaks to the IO and whatnot. So every one of our loans has to be at 70% or less loan to value at maturity. That's how we'll look at it.
So Tony, wise one. You have any recommendations for people that are thinking about buying apartments? Any recommendations of how to protect the downside risk?
You asked me, and your belly bug is the IO. Mine is the low cap rates that guys are buying properties at. I mean, I see 4s and certainly see 5s all the time, and it does concern me because are you going to be able to sell at that same level, or is it going to be a 6 or a 7? And so my advice to you is go long on your financing. In other words, go 10 years instead of 5. And this hybrid product is great because with Freddie, it's really a 20-year product, and with Fannie, it's a 30-year product. So who knows what's going on 6, 7 years, 10 years from now when your loan matures. That's one way you can protect yourself because the loan will then convert to a floating rate and you'll have, with no prepayment penalty, and you'll have some options at that point in time. But that's my biggest concern is you guys are beating each other up on properties, and these investment sales guys are doing a great job, but these low cap rates is my biggest concern of what's going to happen down the road. Can you get out, or sell for a profit?
So I've done this for 34 years. I agree with Tony. We got a guy here, his bank, great bank, come in, go out, refinance with these guys. So I'm a big believer putting everything on long-term, non-recourse debt, because we know if we're buying it today and values start to go down, I can still have this loan that does not have a maturity coming to my head anytime soon, that I know just on the backside of the deal, when it comes out, it's going to be even more valuable after it comes out of the recession. So put it on longer-term debt as much as possible. 20-year term, 30-year amortization. 12 to 15-year term, 30-year amortization. 12-year, 30-year term amortization. Whatever. 25-year amortization, 4 to 5-year term. Get out after all the work has been done. Put it on this type of long-term permanent financing. James, anything to do before we go?
What gets a quick no? And we're going to make this hard. You can't copy the answer of the person before you.
Jeez.
Felonies.
Let's start with Robert first, because Robert, what gets a quick no? Let's talk to your boss. What gets a quick no?
As soon as I bring it to my boss.
That gets a quick no.
No.
Thank you, Jonathan. Thank you.
We'll pull up a picture first thing, see what it looks like. If it's not a property we want to be a part of.
Will you do a crime report on the property?
You know, I think the crime reports are kind of a secondary thing we do. Basically, if we walk the property and think we're going to get gunned down, we're probably not going to do the deal. Seriously, though, you'd be surprised. But, you know, a second piece that's going to be an absolute no is, you know, we'll always kind of preliminarily underwrite a property based on, you know, what we think the property can do and what it can pro forma to. If it's just way out of whack, if there's just too much, you know, needed upside to make the deal make sense, we'll get out of it at that point. But we're always quick. We don't string you along. We'll tell you we can't do the deal within, you know, 2 or 3 days.
So condition of property, I get that. Tony, what gets a quick no?
Recent bankruptcy.
Ooh, recent bankruptcy. Okay. That's an easy one. All right. How old is the bankruptcy? Is it like 7 years ago, like when all the economy was falling apart? Do you not forgive?
It used to be a stigma that stuck with you for about 10 years. We've gotten deals done, you know, in less than that. But if it's in the last 1, 2, 3 years, that's going to be problematic. It's going to be a real challenge there. If it's certainly more than 7 or 10, I think that's one we can do. So
okay, I get that. Thank you, Fritz.
I'd say my easier answer is probably 50% vacancy. Like, it's a pretty much quick no for us. But, you know, you said it earlier about gunshots and the crime report at the property. Our John Banyard, our chief credit officer, is here, and we actually have a story. Heather Hubbard, who's here too from our office, we went on a site visit, and she was going into one of the units, and there was a gunshot hole through the unit, and I think that was a pretty much a no from there.
That was a no. All right. John, what gives us a no immediately? You'll be the last question.
Well, I gave you the felony
answer.
convictions, but usually if I see an expense ratio that's north of 75%, then we're looking at a hotel. So you know, there's something going on there, and I don't want to be the one to try and figure it out.
So, James, anything else? All right, a round of applause for your new best friends.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.